There is no doubt, however, that so long as rates are, if you like, being kept up, that zombie corporations who took out debt needlessly, when interest rates were zero bound, are now having to refinance because this is 5 years later. And a lot of refinancing is ahead, and that is going to hurt these businesses hugely. And I think there's potentially some huge liquidity problems, if you like, in the industrial sector. So that, I think, is the overall situation. But of course, the problem as far as banks are concerned is that having puffed up the financial bubble, particularly equities, that bubble will pop. And when it pops, then there's going to be trouble. So at the moment, banks are not in trouble, but when it does pop, they will be in trouble. Basically, it was a combination of two things which have brought on a liquidity squeeze, if you like. The first is that the Fed was quantitative tightening. That was continuing, and that was taking credit out of the system. And the second thing is that the government shutdown basically meant that T-bills, the sale of T-bills was basically accumulating in the general account, which effectively was taking credit out of circulation. So it was the combination of those two things that led to a spike in the repo rate. It wasn't that serious, but you could see that the Fed was being forced to change its objective from trying to control inflation, trying to get the inflation rate down by maintaining interest rates up, to ensuring there's sufficient liquidity in the system, basically, by stopping QT and introducing QE, because QE basically expands the amount of credit in the system. So there's a complete turnaround, if you like, in the Fed's policy. And a lot of that is why gold has really performed so well in recent weeks. I know there's been a bit of a reaction recently, but you can see how reaction looks like it's over and we're going up again. Put another way, it's the market's vote on the dollar, which is going down under this change of policy regime. The banking system is sort of okay. I'm looking at the American banking system. We'll concentrate on that because that's the most important one. Basically, they haven't really been lending to, if you like, non-financial private sector borrowers that much. Their lending in the private sector has been rarely angled at financial markets and consumers. So really what they're doing is they're promoting asset inflation and they're promoting consumer-driven price inflation. So, there's been no way that there's been an increase in credit aimed at production. I think this is terribly important to understand. So the idea that inflation is going to go away, you can forget it. And on top of that, we've got Trump's tariffs. Now, the apologists for President Trump say, well, look, everybody was saying that it's inflationary, and where's the inflation? But the fact of the matter is that it takes time for the consequences of higher tariffs to work through. And my goodness, they will work through. So that's, so in general, I don't think the problem is so much in the banking system.
While the financial system appears stable on the surface, U.S. banks have largely avoided lending to productive businesses. Credit growth has skewed toward markets and consumption, inflating asset prices and boosting household spending pressure without supporting real economic expansion. With tariffs and supply-side inefficiencies still working through the system, structural inflation remains deeply rooted. Companies that loaded up on cheap debt during the zero-rate era now face refinancing at far higher yields, threatening waves of corporate distress. As refinancing walls approach, liquidity risks increase, especially in manufacturing and industrial sectors, setting the stage for economic stress despite banks' current calm exterior.
There is no doubt, however, that so long as rates are if you like, being kept up. That zombie corporations who took out debt needlessly, when interest rates were zero bound, are now having to refinance because this is 5 years later, and a lot of refinancing is ahead, and that is going to hurt these businesses hugely. And I think there's potentially some huge liquidity problems, if you like, in the industrial sector. So that, I think, is the overall situation. But of course, the problem as far as banks are concerned is that having puffed up the financial bubble, particularly equities, that bubble will pop. And when it pops, then there's going to be trouble. So at the moment, banks are not in trouble, but when it does pop, they will be in trouble. And the Fed will do everything it can to keep the bubble going. It will try and, it'll rescue anything, basically, which is large. I mean, smaller and medium-sized businesses haven't got a hope in this environment. But the larger ones will be rescued. And of course, the way they do that is by debasing the dollar. And it's just smelling the air, really, what gold is doing, if you like. That's really why gold not only has risen so sharply in recent months, but is likely to continue to do so.
Despite outward confidence, the financial system remains tethered to a fragile equity bubble inflated by years of artificially cheap money. If major asset prices break sharply, banks could face severe losses. The Fed will almost certainly intervene to preserve large institutions while smaller businesses are left exposed. Such rescues come at the cost of further dollar debasement, reinforcing gold's momentum as investors seek monetary safety. This cycle of intervention and currency erosion highlights a broader trend, growing doubt in fiat systems. Once markets sense that central banks must prioritize crisis management above currency stability, confidence begins to fracture.
The problem here is that not only will inflation go up, but it's likely to go up considerably. Because, I think, sort of Keynesians and monetarists who sort of look at statistics to try and judge how these things are likely to progress have got the wrong end of the stick. This is human action. And what we're going to see next year, and it's absolutely plain, is you're going to see the bubble, the bubble bursting, and faith, if you like, in fiat currencies diminishing. We're coming to the end of the fiat currency era. And on that basis, what they call inflation is going to soar, and it's going to soar far higher than anybody thinks. Really, what it's reflecting, what it will reflect, is a falling purchasing power for the currency. And the currency will be debased by the central banks. They've got really no alternative but to do that, because the priority nowadays for governments basically is to manage crises. It's to manage economic outcomes. It's to rescue every business, which carries votes or potentially can carry votes. So the entire banking system, the entire sort of, if you like, system of zombie companies, of which there are so many, they've all got to be rescued. And of course, it's an international problem as well. So, the Fed can probably look after its own patch by killing the dollar, but that doesn't stop systemic risk coming in from elsewhere. And the systemic risk, it seems to me, can come in from two sources. The one is that other banks failing, rather like Credit Anstalt did in 1932, which created a banking crisis, if you like, another additional banking crisis to the one that they already had globally and also in America. And I think, I just cannot see how the Fed can prevent this. The other problem is of course, problems in the derivative sector. What we are seeing basically is, derivatives and precious metals have lost, if you like, the pricing power to control the value of the underlying metal, which has been the system deliberately, really, since the 1980s. That is going now. And so we are going to be seeing, I think, a collapse, if you like, in the precious metals derivatives system. And that'll spread into other things like other commodities, energy, other metals like copper and so on. So this is a very interesting time, if you like. So those two things, I think, you've got systemic risk globally within the banking system. And I mean, to some extent, other jurisdictions, G7 jurisdictions, or even jurisdictions which are not in the G7, if they're tempted to bail in as opposed to bail out a bank, then they're going to create an awful mess. I mean, that could be a real crisis. So we've got very difficult times ahead, Patrick, and I think it would be very foolish to ignore them.
For decades, derivatives markets influence the pricing of gold and silver. But as physical demand accelerates and central bank appetite surges, the leverage-based pricing model is losing control. Shakeouts still occur, often driven by short-term speculative pressure, yet underlying buying quickly returns. Open interest rebounds show traders re-entering as soon as dips end. Institutional exposure to metals remains remarkably low, around 0.5%, despite performance outpacing major tech stocks in recent months. If global portfolios attempt to raise allocations by even 1%, the physical demand surge would require tens of thousands of tons of metal, achievable only at drastically higher prices.
There's a bit of profit taking, but not hugely. It had got to the point, I think, where the shorts, the establishment shorts, bullion bank trading desks and so on and so forth, could see that the markets were vulnerable to a shakeout. So they shook it out. And, amongst my Substack subscribers, I know of some who were shaken out, despite me saying, look, for goodness sake, don't trade this because you'll get slaughtered. Just stack. And, I'm glad to say the vast majority of them do that. But one or two of them on the edge have really got caught. And I don't know when they'll get back in because they're thinking like investors. This is not an investment story. This is a protection story. It's not a question of trying to, accumulate wealth. It's a question of protecting wealth. That is the key to understanding really what is going on and and how you should react to what is going on. Protect wealth, and protecting wealth basically means getting into real money and getting out of credit. Just get out of credit as much as you can. The ups and downs in the market then become completely irrelevant. That's the way to look at it. But it was interesting that this shakeout has actually occurred at a time when gold and silver were not overbought at all. If you look at the indicators like mechanical indicators like the relative strength indicators, then it was overbought. But, if you look at actually what was happening in the market, like open interest in these contracts, the open interest was sort of slightly below the average, which tells us that speculative activity is not that great. So the shakeout wasn't going to really shake out an awful lot of stale bulls, or bulls, if you like. That just didn't happen at all. It's interesting that the first sign of metals recovering from this sudden shakeout.
The deeper issue is not investment sentiment. It's the structural trajectory of modern currencies. Years of debt monetization, political pressures, and interventionist policy have eroded trust in fiat systems. As governments prioritize bailouts, crisis management, and short-term voter incentives, currency stability becomes secondary. Historically, such environments end with severe loss of purchasing power. Unless central banks re-anchor money to a tangible standard, traditionally gold, the downward slide accelerates. Yet decades of policy dogma have distanced economists from sound money principles. Without substantial political will, fiat dilution continues unchecked, reinforcing the appeal of holding real, non-debt money.
You've got people getting back on board quite quickly in COMEX. I mean, the open interest in COMEX yesterday on provisional figures jumped something like, 12, 15,000 contracts. So you can see that there's an awful lot of people thinking, oh, we made a mistake. if you see what I mean. This is not an overbought market. It is a market which has been rising on the establishment being squeezed all of a sudden, because nobody really in the investment management field has actually owns gold or silver. I mean, the level of exposure, just looking at ETFs and making a few assumptions about bullion, level of exposure is about 0.5% of all portfolios. This is not excessive. But the problem in terms of liquidity is that people are beginning to realize that the performance of gold and silver is knocking the Magnificent Seven tech stocks into a cocked hat. They're in the wrong things. So they're going to have to move out of those stocks into gold and silver, just purely, on demand for performance basis. But the problem there is to increase average exposure by 1%, only 1% in gold, involves the purchase of 25,000 tons. So how does this get resolved? The answer is it only gets resolved at far, far higher prices. Now, that's an investment management analysis. It actually backs up the correct analysis, which is very, very different. And that is, it is the value of fiat currencies coming to a conclusion, an end. We're looking at the end of the fiat currency system, and their values will decline until such time as the central banks who issue these currencies actually take the means to secure the value of these currencies. Now, what that basically means is you've got to tie it to gold. There's no other option. But, if you look at the American situation, they've spent the last 54 years denying that gold is part of the monetary system and that it has been replaced by the dollar. They are all intellectuals, sort of macroeconomic, Keynesian or monetarist intellectuals.
Global financial risks are converging. Vulnerable banks abroad, fragile derivatives markets, and governments exploring bail-ins instead of bailouts. Precious metals derivative structures, long used to suppress volatility, are weakening as physical markets assert dominance. Systemic cracks might emerge from unexpected regions: corporate debt markets, foreign banking collapses, or commodity-linked derivatives. If confidence in fiat currencies drops sharply, policymakers may lack the expertise or unity to act decisively. History shows that monetary resets often follow prolonged denial. Until meaningful reform arrives, gold remains less a speculative asset and more a final refuge. The trajectory points toward a fiat endgame, unless a radical monetary shift intervenes.
Who actually don't understand economics in the classical sense, which is the only sense that really matters. And so, how does the whole system, if you like, which is based on fallacy, turn around? It's not going to turn around quickly. And of course, the problem is that, when you've got a fiat currency, things are driven by politics. And when they get driven by politics, effectively, central bankers are powerless to take the right action. They're not getting the right advice from all the PhDs they employ. And not only that, but they wouldn't be allowed to take the right actions by their lords and masters, who, I know all this stuff about central banks being independent, don't believe it. At the end of the day, they are political appointees, and their lords and masters are the politicians. And the politicians basically cannot step in and sort things out. I mean, the only way they do that is basically when their currencies lose all their value. And so what's that mean? It means that, the dollar goes down to zero. It's, there could come a point along there where, there's enough of a mandate from the public or President Trump, if he's still in office, to actually authorize the correct action to fix the value of the dollar to gold, to turn things around. But the man's a spendthrift. He's got to turn around completely. And he's not a person who accepts blame for things easily. He's not a man who says, oh, I got it wrong. We have got to get this right. No, he's a man who basically, like Captain Carpenter in the poem by, I can't remember who it was, an American poet, you just battle on until he's dead. I mean, and so we can begin to sympathize, if you like, with Rudolf Hammerstein, who was the head of the Reichsbank in Germany in the early 1920s. There is no option. There is no option. So we know where this is going. You just got to look and understand. That's where we're going. It's the end of the fiat currency system. The end of the fiat currency system basically tells us that it ends with fiat currencies being completely worthless. It's a process that can be stopped, but I just cannot see that there is the political will, the political mandate, and the intellectual understanding of the advisors to actually stop it. So I assume it's going down to zero until I know otherwise.